the later part of issue of shares, that is forfeiture of shares. Forfeiture, the meaning is cancellation. If a shareholder fails to pay the allotment money or call money or both on his shares, the directors can forfeit his shares if they are authorized by the Articles of Association to do so. I'll repeat, if a shareholder who have failed to pay the allotment money or the call money or both on his shares, the directors can cancel his shares if they are authorized by the Articles of Association. The directors have to give a notice to the defaulting shareholder asking him to pay the amount due from him together with the interest on amount overdue on or before a certain date specified in the notice. A date is given, so he is being asked to make the payment of that call money due along with the interest within a specified date. After the forfeiture, the defaulting shareholder ceases to be a member of the company. That means his name as a shareholder is going to be cancelled. So that shareholder ceases to be a member of the company. The amount received by the company on the forfeited shares will be a special profit for the company, but this amount should not be utilized until the forfeited shares are reissued by the company. These forfeited shares or the cancelled shares are going to be reissued by the company. Till then, the whatever amount collected from the shareholder who have paid application money and the other allotment money or first call money, so this amount is not going to get it. So instead of that, that is going to become a profit to the company, and that profit cannot be utilized for any purpose till those forfeited shares are reissued by the company. Entry for recording the forfeiture of shares. The first journal entry is share capital account debtor to forfeited shares account. Okay, share capital account, because this is already being a share capital account is already credited. Now it has to be that to that extent the amount of share capital is to be debited, so that the balance sheet, the share capital will reduce by that amount to forfeited shares account, to allotment account or share call or account or both that are in arrears. If both the allotment money and share calls are in arrears, so then they both are supposed to be written here. So this is for the amount already received in the form of allotment money and share call money. If the shares are reissued at par, bank account debtor to share capital account. I have already mentioned the forfeited shares are not going to be retained by the company. Instead of that, they are going to be reissued by the company. When the shares are reissued by the company, journal entry is bank account debtor to share capital account. If the forfeited shares are reissued at a premium, so in that case, bank account debtor to share capital account to securities premium account. So this is in case of if the shares are reissued at premium. The first one is if the shares are reissued at par, and the third one is if the forfeited shares are reissued at discount, bank account debtor to forfeited shares account debtor to share capital account. I'll repeat, bank account debtor, forfeited shares account debtor to share capital account. So here this is about when the forfeited shares are reissued at discount. Profit remaining in the forfeited shares account. So forfeited shares account debtor to capital reserve account. So when there is a profit remaining in the forfeited shares are going to be transferred to share capital reserve account. Underwriting of shares and debentures. What do I mean by underwriting? It is an arrangement entered into by a company, maybe a financial institution or commercial banks, etc., with one or more persons or institutions called underwriter or underwriters, who undertake to take up the whole or a certain portion of such of the offered shares or debentures as are not subscribed for by public in consideration of certain remuneration is called as underwriting commission. See, when the company issues shares to the public, there is no guarantee that all the shares which are issued by the company are going to be subscribed by the public. So therefore, to get the full subscription for the shares issued by the company, these companies who are going for IPO, they are going to appoint the underwriters. In this case, the underwriters are going to underwrite or purchase the shares which are unsubscribed or not subscribed by the public, and this system is called as underwriting. What are the advantages of this underwriting of shares and debentures? The first one, it is considered as an insurance against a risk of undersubscription of shares or debentures. See, there is a guarantee that like all the shares which are issued by the company are going to be subscribed. If not by the public, it would be by the underwriters. So that guarantee is there. There is insurance against that risk of undersubscription. Then very useful to a new company to raise the capital required for starting up a business. For a new company, there is no guarantee that they are going to all the shares will be subscribed by the public. So in such cases, if there are underwriters, they are going to purchase the shares which are not purchased by the public. So that is very useful to a new company. When there is an underwriting arrangement, the company gets a large sum of cash at once from the underwriters, irrespective of the sale of security. Okay, whether the securities are sold or not, even if the securities are not sold, company is going to get the money of full issue because of the underwriters. When there is an underwriting arrangement, a company can assure of getting a required capital within a definite period. So within a definite period, the company is going to get because of the underwriters. By means of underwriting, a company is relieved of the burden and trouble of raising the required capital. As there is a guarantee that underwriters are going to subscribe the unsubscribed shares of the company, there is a very guarantee or sure that they will get the required capital. When there is an underwriting agreement, the company need not bother about the money market conditions and the possible public response to the issue. Usually, when there is a public issue or IPO or FPO, the demand for the shares issued by the company depends upon the money market or the market condition. If the market condition is not good, actually, usually people are not going to show interest to buy the shares of the companies issued. So, since there is an underwriting system, there is no, they need not bother or worry about the money market conditions and possible public response. The risk of discredit of a company due to failure of public issue of shares or debentures can overcome through underwriting. Okay, see now, if the company shares are not fully subscribed, then it becomes it is going to affect the image or goodwill of the company. But that kind of disadvantages can be solved with the help of underwriting system. The association of underwriters with the issue of shares or debentures of a company would raise the issue high in the public estimation. So this is another benefit of the underwriting system. The underwriters have an arrangement with the brokers in different areas for obtaining the public subscription. So when there is an underwriting arrangement, there will be wider geographical dispersion of the securities. Because of the help of underwriters underwriting arrangements and their contact with the brokers, the issues are going to get a wide geographical dispersion. Underwriters provide expert advice to the concern regarding type of securities to be issued, price at which the securities are to be issued, etc. So this kind of valuable information the companies are going to get from underwriters. This is another advantage. Underwriting assures the safety of funds of the investors. Okay, this is another benefit. So since underwriters are going to buy the unsubscribed shares of the companies, there is sure that even to the investor there is a guarantee that like all the shares are going to be subscribed and they are all going to trade very well in the market in the future. So therefore there is a safety even to the investors. Who is an underwriter? Okay, underwriter are those who underwrite the shares. Underwriting here means they are going to purchase the shares during the time of when these shares are not purchased by the public. So they underwrite the shares or debentures issued by the company. Sub-underwriting. So an underwriter may enter into sub-arrangements with the other underwriters called sub-underwriters. Under this system, the sub-underwriters undertake to underwrite some shares or debentures of the company underwritten by the underwriter for some commission. Such an arrangement is called as sub-underwriting. See, a financial institution is going to act as the underwriter for a company, and these financial institution who has acted as an underwriter to a particular company can give few shares, or like for that company, some of the other companies, other financial institutions can act as underwriters. So the other financial institutions who are going to act as underwriters to the first financial institution, they are called as sub-underwriters. SEBI guidelines for underwriting. According to SEBI guidelines, underwriting is not mandatory. There is no compulsion that all the issues are supposed to be underwritten by the underwriters. However, if the issue is not underwritten and the minimum subscription of 90% of the offer to the public is not received, the company should refund the entire amount received as subscription. So suppose if there is no system of underwriting as per the SEBI guidelines, the issue is not underwritten and the minimum subscription 90% of the offer to the public is not received, in that case the entire amount collected from the public has to be refunded. So to avoid this kind of risk, usually company go for underwriting. In case of issue, in case the issue is underwritten and if the company does not receive 90% of the issued capital from the public's subscription plus the accepted development from the underwriters, within 120 days from the date of opening of the issue, the company should refund in full the entire amount of the subscription received from the public. Okay, now here, in case issue is underwritten and if the company does not receive 90% of the issued capital from both public as well as from the underwriters, in that case also within 120 days, the company has to refund the entire amount collected from the underwriters and from the public. The lead manager or managers to the issue must satisfy themselves about the net worth of the underwriters and their outstanding commitments and disclose the same to the SEBI. See, they have to disclose the information about the net worth, who the lead managers or managers of are none other than the underwriters. They must mention specify and they must disclose the net worth of the underwriters and their outstanding commitments and disclose the same to SEBI. The underwriting agreement may be filed with the stock exchange. So this agreement has to be filed with the stock exchanges like NSE or. Though the maximum rate of underwriting commission allowed by a Companies Act is 5% of the issue price in case of shares and 2.5% of the issue price in case of debentures. In practice, SEBI has allowed underwriting commission only at the rate of 2.5% of the issue of equity shares. The rate of underwriting commission allowed in case of preference shares and convertible and non-convertible debentures is as follows. For amounts up to 5 lakh, it is 2.5% on the amount revolving on the underwriters and 1.5% amount subscribed by the public. See, this is the commission, 2.5% on the amount revolving on the underwriters and 1.5% on the amount subscribed by the public. Then for the amount in excess of rupees 5 lakh, 2% on the amount revolving on underwriters and 1% of the amount subscribed by the public. So this is the way how the commission is to be given to the underwriters. Type of underwriting. On the basis of the number of shares or debentures underwritten, there are methods. So first one is complete underwriting. It is an arrangement under which the whole of the issue of the shares or debentures of a company is underwritten by a single or multiple underwriters. The entire issue is going to be underwritten under complete underwriting. Second one is partial underwriting. It is an arrangement under which only a part of the issue of the shares or debentures of a company is underwritten by a single or multiple underwriters. So it's very simple. A part of the issue is going to be underwritten by the underwriters. On the basis of the liability of the underwriters in respect of shares and debentures underwritten by them, the first method is open or pure underwriting. So it is an arrangement under which an underwriter or underwriters agree to take up the shares or debentures of a company only when the whole or the part of the issues or offered shares and debentures of a company underwritten by him or them is not fully subscribed for the public. Okay, shares or debentures which are underwritten, but if they are not subscribed by the public, in that case they are going to underwrite them. Okay, so it is an arrangement under which underwriter agrees to take up only the shares which are which are not subscribed by the public. They are going to be taken up by the underwriters. Second one, firm underwriting. It is an underwriting arrangement under which an underwriter or underwriters make a firm commitment to take up the specified number of shares or debentures of a company, irrespective of the number of shares or debentures subscribed by the public. So whether the shares are subscribed by the public or not, these underwriters are going to take a specified number of shares or debentures of the company. So that is called as firm underwriting. They are committed to take up a specified number of shares, irrespective of whether the shares are subscribed or not subscribed by the public. But in case of open or pure underwriting, underwriters agree to take up the shares or debentures of a company only when the whole or the part of the issue of shares or debentures of the company underwritten are not subscribed by the public. Open underwriting versus firm underwriting. Liability of the underwriter is only conditional, that is only if there is under subscription, otherwise they are not going to subscribe, they are not going to subscribe or they are not going to take the liability. The liability of the underwriter or underwriters is absolute and not conditional. So whether there is under subscription or over subscription, these underwriters, firm underwriters, are going to take a specified number of shares. The liability of the underwriter or underwriters arises only from the open underwriting arrangement, whereas in case of liability of the underwriter or underwriters arises from both open underwriting and firm underwriting. So in case of open underwriting also, firm underwriting is going to take place. Even if the shares are fully subscribed or oversubscribed, even this underwriters are going to take up the specified number of shares. And open underwriting can exist by itself because as soon as the shares are not subscribed by the public, they are supposed to be subscribed by the underwriter, so therefore it exists itself. It always goes with an open underwriting. So here firm underwriting goes with an assumption that like there is an open underwriting, that means there is a under subscription. So with that assumption, like they have agreed to purchase or take up a specified number of shares. The company is not bound to allot any shares or debentures to the underwriters if there is full or over subscription by the public. But in case of firm underwriting, the company is bound to allot to the underwriters or underwriter the shares or debentures which he or they have underwritten, even if there is full or over subscription by the public. Marked versus unmarked application. What do you mean by marked application and what do you mean by unmarked application? Let us discuss the difference between them. See, applications are bearing the official stamp of the single underwriter or of the respective underwriters are called as marked application. If the applications are bearing the stamp of the single underwriter or the respective underwriters, then it is called as marked application. Unmarked applications are the applications received directly from the public which do not bear the official stamp of the underwriter or underwriters are called as unmarked application. Accounting entries relating to underwriting of shares or debentures. Entry for recording the allotment of shares or debentures to the underwriters in respect of their liability. If the shares or debentures are issued at par to the underwriters, underwriters account debtor to share capital account. So this is the first journal entry when the shares are issued at par. And next underwriters account debtor to debentures account in case of debentures. Okay, so in case of shares it is underwriters account debtor to share capital account, and in case of debentures underwriters account debtor to debentures account. If the shares or debentures are allotted at a premium, okay, underwriters account debtor to share capital account and to securities premium account. So underwriters account debtor to debentures account to debenture premium account. This is in case of debentures. If the shares or debentures are allotted at a discount, so underwriters account debtor discount on issue of shares account debtor to share capital account in case of equity shares or preference shares, or in case of equity debentures, underwriters account debtor discount on issue of debentures account debtor to debentures account. Entry for recording underwriters commission payable to the underwriters. So as we all know, like underwriters are eligible to get the commission. To record them, you have to pass the journal entries. The journal entry is commission on issue of shares account data, commission on issue of debentures account data to underwriters account. Entry for recording underwriters commission payable to the underwriters. So the journal entries are like, if the final balance is due from the underwriter to the company, then bank account data to share capital account. Okay, this is the journal entry. This is the entry for recording underwriters commission payable to the underwriters. If the final balance is due from the company to the underwriters, underwriters account debtor to bank account. See, we have already stated there, like underwriters account debtor to the share capital account for the shares which are underwritten. So there it was debited, and here it is credited to for receiving the commission. Okay, it is credited, and so in case if company has, sorry, underwriter has to give a balance amount, like see the total amount of shares which are subscribed by them minus their commission, and if there is a positive balance, in that case that has to be given back to the company, to the company. So in that case, bank account debtor to share capital account. I'll repeat it with an example. The value of the shares subscribed by the underwriter is 10,000, whereas the commission that he is going to get is 5,000. So remaining 5,000 he has to give to the company. So in that case, bank account debtor to share capital account. If the final balance due from the company to the underwriter, so in that case, underwriters account debtor to bank account. See here, it's quite reverse to the previous example. The shares underwritten by him is 10,000, whereas the commission that he is eligible to get is 15,000. So 5,000 company has to give to him. So in that case, underwriters account debtor to bank account. If there is a discount on issue of shares as well as a commission on issue of debentures, so how to write the journal entry? Cost of issue of debentures account data to discount on issue of debentures account. So I'll repeat, cost of issue of debentures account data to discount on issue of debentures account. Okay, so this is in case discount on issue of debentures as well as commission on issue of debentures to commission on issue of debentures. I'll repeat here, this is the total cost of issue of debentures. So these are the two expenses. One is in the form of discount, the other one is in the form of commission. These are the two losses arises while during the time of issue of debentures at discount. Okay. Thank you.